Hi everyone and welcome to Symax Fintech's weekly market insight. First, a disclaimer. So trading involves the risk of loss of capital. It's not suitable for everyone. As I say every week, hopefully it is for you. Many companies provide leverage. Just be careful with that. You can lose substantially more than that initial investment. It's better these days because of regulation, but it's still not perfect. So always check the small print. Views, opinions, everything contained in these purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And of course, to do that, you must decide on and consider the risks, your financial situation, your level of experience, most definitely, and of course, your risk appetite. And most importantly, you should only risk capital you are prepared but can afford to lose. Don't put yourself in debt. Make sure you've got plenty of savings to cover yourself. Depending on what you've got, consider as a suggestion, purely a suggestion, 10% max. You don't want to be risking too much of your capital with trading. Any doubts whatsoever, seek independent financial advice before you start risking that capital. Okay, so last week was very interesting. Stock earnings were still a bit mixed. We had the Fed that raised rates for a record consecutive fourth time of 75 basis points. They're now up to 4%, so they've played catch up quite well, I suppose. Of course, the increases are expected to slow down, maybe, not so much as aggressive, but they will continue for longer. They're determined to beat inflation. They want it back down to their desired 2%. Although, the supply chains are the issue, so they may have to settle for 3%. But, they dream of seeing that for the moment. And then, of course, the Bank of England copied and raised by 75 basis points. I thought it was probably going to be 50, but they stuck with the 75. They're now at 3% in the UK. And recession, it's coming. Data's pretty good at the moment. We're leading up to Christmas, so I don't think it's really going to hit home until probably early next year. But even the Bank of England warned that we could have the deepest or longest, possibly both, in the way of a recession for 100 years. And then moving on to NFP, so non-farm payroll was a beat, 261,000 new jobs. But of course, along with that was the fact that unemployment did pop up a little bit. It's been ranging between this 3.5, 3.7%, which is great. Don't get me wrong, that's considered practically full employment for sure. And you can tell that by the amount of jobs that there are on offer. Weekly hours remain constant. Earnings month on month again up, so 0.4%. It's where companies are trying to attract the workers. And then, of course, the USP PMI over 50, so it's still showing growth there. ISMs were lower than expected, though, and the JOLTS increased to 10.7. That's the job openings that are available. So there's still more jobs available. The level of jobs available to the unemployed is actually, it went from 2% down to 1.65. It's now back up to 1.9 again. So that's sort of a little bit of a turnaround there. And of course, we're still seeing Germany struggling at the moment. Retail sales were lower. Part of it is inflation. Part of it is also they're still waiting for supplies to come through. It's still sort of affecting them for sure. And then of course, we've still got sort of high inflation from energy, from food and such like. In the EU as a whole, we've got core CPI that's hit 5% year on year, and that's up 1.5% month on month, which is big. And GDP, they just managed to keep it from going negative 0.2%. In the UK, house prices dropped almost 1% month on month. and I would expect to see more of that as well. Although PMI was better than expected. Now, Russia had decided not to continue allowing Ukraine to export grains, but then they've had another reversal and they've now decided to allow that to continue. Part of that, I think, is because Russia seems to push their grains out as well, which produces income for them, under the radar, I would guess, I suppose you would say there. China PMI dropped below 50. Okay, above 50 is still growth. Below 50 doesn't necessarily mean contraction. It's really got to get below sort of 43, 44. So it's still not bad. And obviously there's still a lot going on in China at the moment. But what we are seeing is that real estate is still depressed in China. Australia raised rates, but at a much slower pace, only 0.25%. They're now at 2.85%. And Musk began sacking the Twitter staff. I think all the execs all just went probably almost day one, day two. He wants a clean sweep. And also, it's possible he may get rid of up to 50% of employees, and he's going to make them go to the office now, from what I gather. Companies, though, have begin pulling their advertising because there's going to be less stringent focus on what's being said. So, with that being a little bit more volatile, people don't want to be associated with it at the moment, or companies anyway. We'll have to see how that plays out, though. And at one stage, he voiced this new fee that he was going to bring in, which was going to be $20. It now seems as though that's dropped down to $8. But is it worth it? The guy's going to raise probably about $1 million. Yep, we'd all love that $1 million, but it's just $1 million. Considering what he paid for the company, it's a drop in the ocean, shall we say. Okay, moving on to the data that's out this week. We've got central bank speakers. There's inflation data coming out. And then, of course, in the US, that is. And then we've got CPI. So we're going to see some good inflation data there. It's not the best one that the Fed uses these days. They prefer the PCE. But it will give us an insight into what's going on. And of course, consumer sentiment, from Michigan. And again, obviously, that's another key thing. And it just seems to be holding up really well in America, despite the fact that inflation is high. And of course, all of this is feeding in to what promises to be really interesting midterm elections in the US, which are going to be on Tuesday. Are people going to be concerned about inflation? Yes, of course they are. Is it going to be enough to make them vote for the other party, the Republicans, instead of the Democrats? We'll have to wait and see. And of course, you've got the two houses. Will Biden lose one or both of them if it does start to go that way? Now, if you want to know more about that, then Tuesday evening, 5 o'clock GMT, I will be discussing with Tom from Ninja Trader all about the midterm elections. We'll also be covering the macro outlook. We'll be doing lots of technical analysis on a variety of different asset classes. So there's the link there. Join us, feel free to. We'd love to see you there. It will be a very interesting conversation. He's a great guy and definitely knows his stuff as well. And then on Friday in the US, we've got Veterans Day, so that may lead to a long weekend for many. In the UK, retail sales, GDP, industrial production, manufacturing. So again, how's the high street doing? Our retail sales suffering? The UK does love to spend. So it may be costing more, and of course with mortgages going up and everything, but is it feeding into the economies yet, or is it slowly feeding in, or are we just going to ignore it, accept we're paying higher prices, accept it's costing us more if we're lending, and just get on with life? we'll have to wait and see. In China, Europe, I suppose better cover them. Retail sales, economic growth forecast. The economic growth forecast, keep an eye on that. That's a report, that'd be quite interesting. Is it still going to be growth, or is it now actually heading for contraction, and how quickly? That's going to be the question. With China, we've got trade data and we've got CPI. So again, we're going to see a little bit of insight into how their inflation's going. Now we're going to move on to the macro outlook. Inflation, stagflation, the EU's in double digits, UK as well. Obviously, power prices, food prices still massively impacting. And of course, we're still going to see these rates going higher. And, when rates go higher, that has a slight inflationary impact as well. And of course, if we're importing, or any of the countries are importing from the US, it's costing more because of the strength of the dollar. And then, of course, we've still got sort of the recessions that are heading our way, especially in Europe and UK. Personally, I believe they're going to be global. We're not going to get away from them. But what I'm thinking is that, Europe and the UK are going to be hit first. Emerging markets, of course, are going to get impacted by it as well. The US will probably be the last into proper recession, a real recession, not a technical one. And they'll probably be the first out, just because the strongest economy. And I just don't see that changing for any time soon. And then, of course, in the UK, we've got this fiscal tightening where our government's looking to raise or save 50 billion pounds, that is. That's going to be sort of a cut in services, etc., along with increased taxation. So that is not painting a pretty picture for the UK, especially at a time when we're getting hurt and looking already to go into recession. That's just going to put us in deeper and hold us in there for longer by short. And then, of course, on top of that, we've still got some supply chain issues. You've really got to still keep an eye on COVID as well. It is still around. You're seeing more cases increase. We seem to be dropping off again just a little bit. Last year our government decided to come out with a great statement, or living with COVID, and that's what we're doing. But you read all these medical reports about the long-term impact of COVID and that, which is not so good for people. So fingers crossed everybody is all right. And then the supply chain issues are part of that. With China, with their zero COVID restrictions, although there are rumours that they may actually ease them now. They've got about 200 million people locked down at the moment. But then on the other side of that, we've got container prices, which are back to pre-war levels. However, on Friday, because that rumour sort of came about, you notice gold popped up, oil popped up. So it did have a little bit of an impact on commodity prices, because that will increase demand again. Russian invasion of Ukraine in its 9th month. Russia started attacking the utilities, the power and water supplies in Ukraine, as a little bit of revenge against the fact that Ukraine is regaining a lot of ground and progressing really well. Good on Ukraine, that's all I can say there. Energy prices still increasing. Again, you've got this difference in PPI with, what producers are paying. That's been dropping down, but they're not passing that on to the consumers. So you're not seeing that reduction in CPI. And again, it's a little bit annoying. They've got their profit margins the highest for decades, over 15%. And of course, that's going to keep going for the moment. The biggest sort of tech sector is the tech sector. Obviously they're getting impacted because if we're having to pay more for food and energy, A lot of households have got to make cuts elsewhere. So people are going, okay, I can survive. I can live with this last year's tech for another year. I haven't got to go and buy a new phone. I haven't got to go and buy a new computer or iPad. As long as they work, as long as they do what they want them to do, then they're just going to sort of just accept that they're going to have to wait a year or two before they replace what they're using. You know, of course, they're fashion statements and such like, but you know, priorities are food, energy, you know, keeping the houses warm, and of course, you know, as we're going along now, okay, we had an extended summer in Europe, but that seems to be cooling down now. Now, if that does continue to cool down and sort of drop quickly, which it can do in Europe, then those extra gas reserves that have been sort of stored, which has surprised most, the fact that they've got there, which is great, but it's a matter of how long they're going to last, because, you know, the demand is going to increase for sure. Food prices, I say, remaining a little bit higher still. We've still got that lack of workers, you know, a lot of more people retiring and such like, or the people don't have the right skill set. People are comfortable where they are, you know, and as a recession gets closer and closer, more and more people are likely to say, well, okay, I'll go and earn more money somewhere else, but I could lose that job very quickly, you know, if it's last in, first out scenario. So they may start to sort of ask for less or not ask for more at all, and just be happy to have a job going into the recession. Now the dollar has come off from its highs. It's off about 3 or 4%, and this is on the expectations that the Fed will slowly increase it. But to be honest with you, is that going to make that much difference? Because if they're slowing, the rest of the world are going to slow down their increases as well. Part of it's been competing against the Fed. The other part is competing against inflation. Now, you know, does that mean other countries are going to keep pushing theirs up and up and up? No. I think you're going to see them start to slow down as well. You know, they're going to want to see all this rises that they've made in the markets feed into the data and see what impact it is really having on consumers. You know, the one thing I would say about rates is, you know, cheap money is gone. And you're not going to see those low rates again until there's the next crisis. And even then, you might not see the zeros and all that, because, you know, this has been a bit of a wake-up call for the central banks. They may hold back. They may cut rates, but they may not be so aggressive the next time round because of that. But they're going to hold them higher for longer, because at the end of the day, they've got to get that inflation under control. And as I keep saying and warning people, that if it means pushing the markets, pushing the economies into a recession, they're going to do it. It's the only way they can reset the economy and start again. You know, crash demand, balance it with supply, and then work out what to do. And I can see that quite honestly going into the end of 2023 or even 2024 before there's even any consideration of change of policy. But, you know, that's, again, you know, just remember, that's just my personal view. Now, the other thing we've got, obviously, is with this midterm elections, it's probably going to decide whether Trump is going to run again in 2024. So there's a good chance that he will, which again is great for the market. He's such an interesting guy. You know, God, I could do a whole hour on him, but I won't. Okay, right. So now we're going to move on. So my trading tip of the week is about fundamentals. So fundamentals, you know, the fundamentals, learn about the fundamentals if you're unsure of them, because they determine the market direction, the trend and the volatility. And that is really important to you as a trader. If it's not, there's something wrong. It should be. Market data, you know, what the central banks are doing, what they're talking about, what they're, you know, people expect from them, what traders and investors expect for them, and from the government. And, you know, you've almost got the central banks and governments on opposite sides at the moment. And then you got QE, which we've had and has gone now. We've got QT, which is now happening. And then it's a matter of, how aggressive that's going to be. Personally, I still think central banks should be selling off their assets at a faster pace to reduce their balance sheets down. Just allowing them to mature is so passive. For me, it's just ridiculous that it takes them so long. If the US carried on at 95 billion a month, it would take them 8 years to get down to zero. They'd never get to zero, but you just get my point. Okay, interest rates, obviously you've got to keep an eye on them, the expectations for them, what's priced into the markets, what's expected there. And of course, interest rates are impacting the stock markets, and there's almost an inverse reaction at the moment to what's going on there. Inflation, of course, it's still high. Is it going to stay high? Personally, I can't see it coming off that much at the moment. It's really sticky. Employment is high, but I think you're going to start to see more and more jobs withdrawn, or there's going to just be stale jobs there. That high level of job offers are going to disappear, especially as the recession hits. Now, job losses. Now, I'm not 100% sure on job losses. Sorry, I'm getting a little bit into macro again here. But the reason for the job losses may not be as high is because these companies may be scared that they can't actually get the workers back again when the recovery comes, because they've been hurt by it this time round. They've really struggled to get staff. And then, against the fundamentals, we've got the technicals. Now, I always say, fundamentals drive the market. The technicals, we use them for timing, to improve our timing for our entries, our exits, and where to place our stop loss. So, if you're not up to date on all of this, either go on the internet and learn about it, or contact us. We do courses on all this stuff. We're here to help you as much as possible. Okay, so let's move on to our technical analysis. Just a little reminder in case any of you are fresh to this. The black numbers on the right are support resistance levels. The brown numbers are breakout levels. Any claret numbers, they're just levels that I've either identified, or they could be based on double or triple tops or bottoms. I've got some Fibonacci in there this week, so just bear in mind for that, for the colours. I'm sure you know them anyway. The lime green just above the red is the big one. That is the golden ratio there. So, okay, so let's look at some of the markets. Stocks had a bit of a mixed week reacting to the market data that came out. Obviously, the Fed, and everything that's been going on. So I've added the fibs onto a few charts this week as well, just to give you a little bit of insight what's going on there. So anyway, let's start with the Dow Daily, and on here I've got resistance at 34,038 and 33264. Support I found at 31740 and 31293. Okay, so here's the fibs on here. So the Dow's the only one out of the stock indices where it's actually got through any of the fibs yet. But you can see from there it's been even up above the 50, but it's failed to maintain that by the end of the week, and it's dropped back in between the 0.382 and the 50 level. So just keep an eye on them, but it does give you an idea of where these markets come from and where it's going to. So again, you can see where I've picked the high and where I've got the low from. And then moving on to the 30-minute, I've got resistance at 33,004 and 32779, with support at 31942. Again, you can always take screenshots or take a picture with your phone, just to sort of keep these in your memory. Moving on to the S&P. So on the S&P, on the daily, again, we've got some levels there. So we've got 43.02 as a resistance level. That goes all the way back to April, May. For me, that's a major level. The last time it rallied and got up there was great. It gave me an opportunity to buy put options. Now, this time it's nowhere near that yet, but I'd love to see it get back up there because I'll do more. That's just levels that I've got in my mind. So, again, don't be influenced by what I say or what I'm doing. You've got to make your own mind up. We're just here trying to help you as much as possible. So, so that's the 43.02 level. And then below that, I've got the 41.47 level and the 39.30 resistances with support at 37.07. There's the fib, as you can see, it hasn't even got up to test the 382 level on the S&P yet. It's still holding lower. And it's got a long way to go to get up there. And that's tech stocks holding it back as well as others. So, okay, so moving on now to the 30-minute. On the 30-minute, I can see resistance at 38.82. And support at 37.16. Nasdaq daily, I've got resistance at 12.839 and 11.745 with support at 10.369. Again, tech stocks have not been doing very well. Bad earnings in Q3. As I said, we can sacrifice not buying the latest models of things. And as long as we've got something that works, it's fine. And they're moving on to Nasdaq 30-minute. I've got resistance at 11.360, 10.988, and 10.871. With support at 10.651. Now, I've added an extra chart in this week, and it's a comparison of how the Dow, the S&P, and the Nasdaq are performing against each other. So the blue one is the Dow Jones, the red one is the S&P, and the black one is the Nasdaq. And you can see, that the Dow has been performing much better, really, than the S&P and the Nasdaq. So, that sort of was pretty much what I've been saying on the other slides, but I just thought I'd give you that sort of visual analysis so you can see it for yourself. Moving on to the Russell 2000. Remember, these are the small and mid-cap stocks. I've got resistance at 1868. I've got support at 1729 and 1653. I've added the fibs onto this one as well. Again, as you can see, nowhere near them for the moment. And just going to move on straight away to the 30-minute. Now you've seen them. I've got resistance at 1862 and 1806 and support at 1770. Okay, so now let's have a look at some currencies. They were a bit mixed last week, especially for the dollar obviously weakened a little bit. With expectations they're going to start to cut back a little bit on these rate increases. And the euro and the pound, well, what can you say about them? Any rally in them is really dollar weakness. It's not because anyone's feeling great about Europe at all. So on the pound against the dollar, I've got resistance at 115.52 and I've got support at 110.71. On the 30-minute, I've got resistance at 114.34 and 113.96, and I've got support at 111.69. So here's the euro against the dollar. you can see that it's sort of okay. It's starting to range a little bit at the moment. Depends on what's going on with the dollar more, as I say, rather than the euro. And there I've got resistance at 10104 and at 0.9997, so just under the parity there, and support at 0.9765. On the 30-minute, I've got resistance at basically $1.01, and I've got resistance at 997, 0.997, same as the daily actually there, and support at 0.9777. So moving on to Bitcoin, crypto just seems that more stable at the moment than the rest of the asset classes. Who would have thought that would have happened? Okay, so on here, brown number, so that's a breakout level at 27,385. I know I keep adding it, and it's nowhere near, but with crypto, when it moves, it can be fast. So the moment I don't put it on there is probably the time it is going to break out. So I'd rather add it just in case. And then I've got resistance at 23385 as well, and support at 18,455. Moving on to the 30-minute, and here I've got resistance at 21,470, 21,408, support at 20,652, and 20,536, and 20,035. Here's the Bitcoin versus Nasdaq analysis. Again, as you can see, the Nasdaq's just moving around a lot more than crypto at the moment. Bitcoin just seems to have sort of found its range for the moment. It's popped out a little bit on the upside where it has been recently, getting dragged up by all the other asset classes, having that little pop on the upside towards the end of the week. But it's a matter of whether they can sustain it or not. Now move on to gold. Again, with gold, it got dragged up on Friday. Just with all these expectations and rumours coming out from China, I would say, much more than from what the stocks or even NFP actually did. So I've got resistance at 1680. I've got support at 1621. On the 30-minute, I've got resistance at 1687, and I've got support at 1662 and 1631. Finally, last but definitely not least, is WTI. It had a good rally on Friday, very aggressive rally on Friday, pretty much sort of close to $5. And again, just emphasizing, I would assume that most of that was on the news about China possibly easing restrictions. There's nothing been confirmed so far, so just be careful. And as I say, that probably steadied gold, commodities in general, to be honest. Okay, so now when we look at it on the daily, I've got resistance at 97.64. I've got support at 87.65, 83.23, 79.99. Oh wow, they're so wide apart so far, but oil does move for sure. I love trading oil. And put the fibs on here. Okay, we're not up there yet, but again, it's just to give you an idea. I've sort of tried to work out the exact price. I think it's around about 96.90 where the first resistance line comes in from the fibs, the 0.382 level. And then moving on to the 30-minute, I've got resistance tighter at 92.65. I've got support at 91.96. That is a steep line though, so possibly that will get broken quite quickly. And I've got support at 87.60. 85. So that sort of pretty much finishes the analysis. Again, as usual, just a reminder about our services, what we can help you with, whether you're new to trading or you want to improve your skills at trading. We've got something for everybody. It doesn't matter what level you are. I help guys that have been in industry 20, 30 years to improve still. And the same as for what people that have not even understood what trading or the markets are about. I'd love to get them first before they try their trading and lose money. Okay, so obviously we provide this. To support this, we do a daily newsletter, Monday to Friday. In that, global news, my views, and fresh chart levels daily and pivot points as well. We've got one-day workshops just to help you with any particular area that you feel could improve. We do 1 week courses, which takes you from 0 to hero if you're new to trading. Also, again, there, I even do stuff for employees of exchanges and that. They come to me because they want to understand it more from a trader's perspective. We've got the masterclasses. Now, the masterclass gives you that really deep dive into the fundamentals, as well as the technicals, the risk management. It covers every aspect of trading. And of course, it's 4 weeks of guided learning, but you can split them up. You don't have to do them all in one go. So again, reach out if you're interested in any of those. Trader mentoring. So, if you're already trading but you want to improve, we can work out a plan there for you to help you. We do consulting to a variety of companies, including brokers, exchanges, and of course we provide educational content to them as well as to individuals. Any questions, feel free to reach out to us at info@symaxfintech.com, or if it's a trading question that you'd like my answer to, then reach out to me at chris.tubby@symax-int.com. Have a great week and look forward to seeing you again at the end of next week. So take it easy, be lucky.